Good afternoon, everyone. So can somebody tell me whether this screen is clearly visible to you and my voice is clearly audible or not? And let's wait for 1 or 2 minutes. Okay, let others also come. After this, we'll start. Everyone here? So let's start with our today's session. Okay, so as usual, what we will do, we will try to finish up September part 2. That means whatever news that are relevant from the ESI as well as finance perspective from September 11th to September 21st. Okay, and as usual, we'll start with circulars first. And I also request you to understand the circulars concepts, okay, and then cram the details because that is more important. Okay, and then again we'll see some dynamic news after circulars. Okay, good afternoon, everyone. So today we have a lot of circular news. So mostly our lecture will be limited to the circulars only. So the primary circular is regarding an RBI circular that talks about investment norms for banks. And the governor is saying that these investment norms for banks. Understand the concepts, okay. You have to understand the concepts, especially when the circular is with respect to Reserve Bank of India, for which you are preparing for the exam. Okay, so understanding is very much important, and rest whatever I tell you in this news section that you need to cram. Okay, so we were discussing about the investment norms for banks to get more strengthened, or you can say more stringent. So first of all, let's understand what what are investment norms. And obviously there is a standardized practice with respect to how does bank invests public money. Okay, all bank get money from deposits, not only demand deposit but also term deposits, and at the end they have only limited amount of reserve requirements as per CRR as well as SLR, and rest of the money they either lend or they either invest. Okay, so lending details and lending requirements have a different angle, but here we are talking about how much money and in what way banks can invest. Okay, so let's try to understand this. So we're discussing about investment norms, especially in the banking sector. Okay, so there are three types of securities in which banks invests. There are three kinds of securities. What do we call these three types of securities? First one is held for trading. Next is available for sale. And what's the last one? Held to maturity. So these are the three types of securities upon which these banks invest their money. Now let's understand what do we mean by these three types of securities. The core criteria that distinguishes all these entities or all these types is either their tenure or what's the holding period. Okay, so this is held for trading. That means you are investing in equity or debt securities that you will be selling within 1 year. Okay, so sold within a year. Okay, so these are such type of securities. What is this held to maturity? These are such securities that you keep until they matures. What do we mean by this? Can anyone give me the example of any security that have a limited that has a time period upon which we can hold it and at the end we get the returns? What do you think such type of entities can be? Yes, right, FD. What else? Government securities, or you can say dated securities. So that means the banks are not selling it and holding it for whatever the bond period that is mentioned over there. Okay, so if it is a 15-year FD, it is keeping that FD for 15 years. It is a 25-year bond, then banks are keeping those securities for 25 years. So we've understood the short-term thing, we've understood the long-term thing. So what do you think in between this available for sale would be? It will be having the characteristics of both. That means first it is being held for longer period. This is the first criteria. Next criteria is, but it is it is being held to be sold before maturity. Okay, so longer tenure but sold before maturity. This is the characteristic of available for sale. So if we make a chart, okay, in terms of, let's say this is a time period chart. You can say this is a short term, less than 1 year. This is a long term, 25 to 30 years. So if you map, hold for trading securities here, held to maturity securities here, then available for sale securities would be somewhere here. Okay, so any confusion till now? Because understanding these things are important before you go into specifics of circular. Any confusion till now? At least in understanding of these securities. Just give me a yes or no. Okay. Okay. Now, what does the norm say? Okay, so the new norm says that previously these three type of securities were there. Right now, these only three type of categories are there, but one category has been replaced. And what's the name of that category? Let's first mention what category remains the same. Held to maturity remains the same. Available for sale remains the same. But there has been a new type of category, which is what? Value through profit and loss. And what happened to held for hold for trading? It became a subcomponent of this category. Hold for trading. Okay, so it's just a you can say name change, or it included HFT within this category in order to make, disclosure of HFTs in the balance sheet of the bank more stringent. So this is the new structure. And now let's see what are various other norms that have been given by Reserve Bank of India when we are talking about what? Investment norms. So the primary thing in context of this banking norms is that the category of the investments has to be decided before purchasing them. Before purchase. Okay, so this is the first and primary norm with respect to investments, that any bank, if they are buying any investment entity or any investment opportunity, they have to categorize it before purchasing. This is what the first norm is. Okay. Another norm with respect to classification or categorization of your investments is that after you have categorized or after you have taken decision with respect to any asset class, okay, then reclassification won't be happening just like that. Okay, so you can't reclassify without taking approval from the board and also without taking approval from the Reserve Bank of India. That means if you have categorized an asset as held, hold for what? Trading, then you cannot reclassify that asset as available for sale and vice versa. Okay, so you've classified an asset as available for sale, you can't reclassify it as a hold for trading. Okay, so this is the second very critical norm that Reserve Bank of India is telling you that you are not allowed to do that. Okay. Now what's the next thing? So next thing is about regarding value of this HFT. How do we get to know the value of hold for trading subcategory? Because this hold for trading subcategory is almost, as you all know, equities in short term is very much volatile. If you look at the returns from 2021 peak of stock market till right now, you will feel like that stock market is declining and not giving so much returns. But if you look at in the long term, then you will realize that stock market provide a good amount of returns compared to every other financial instrument if we look at in terms of long term. So that's why the Reserve Bank of India is focusing upon making this a channelized or regulated aspect of investment norms, because this is more susceptible to bank failure. Because if you invest more your funds into HFT, then your public funds are at risk, because stock market, as you all know, is more volatile. Because of even every lecture that we discuss about FIIs either buying, FIIs either selling, and because of those selling and buying, how does our stock market actually increase or plummet? Okay, the next is that sale of investments from HTM category. What do we mean by HTM category? As I've already explained to you, held to maturity. Okay, so held to maturity, as what Lakshay told us about, FD is an example, certificate of deposits is an example, government securities is an example. So these securities you have invested in and you are keeping those securities till their maturity. The norm that's RBI circular has talked about is that you cannot sell HTM securities more than 5% of your HTM portfolio. Now, if you want to understand these things, so it says that suppose you have a 1 lakh crore portfolio of held to maturity securities. So it says that you cannot sell 5% of that 1 lakh crore portfolio. That means 5,000 crores you cannot sell. More than 5,000 crores you cannot sell. Okay. See, this is the most technical circular in our today's session. I will again repeat if you guys don't understand, but let's understand this circular before we do other things, because other things are just easy to understand. Okay. So any confusion, feel free to ask. Then what is next? Next is with respect to creation of a investment fluctuation reserve. So as I've already told you that government or Reserve Bank of India is primarily focused on safety of public funds. And what's the major risk with respect to safety of public funds? It's the hold for trading type of securities. Okay. So because of which RBI has said that every bank has to create an investment fluctuation reserve. Okay. That reserve should be at least 2% of your available for sale securities as well as FP, fair value through profit and loss portfolio. Okay. So this is the objective of investment fluctuation reserve. I know it's very confusing, but let's try to do this again. First of all, understand that this is investment norms provided by Reserve Bank of India. Okay. Investment norms, that means how bank will invest public money. This is the major question that is being addressed by this circular. Okay. A bank invests public money into 3 types of securities. What are these 3 types of securities? Hold to maturity, that I've already explained to you. Hold to maturities are those type of securities which can be either equity or debt that are hold for their, no, this is not equity but mostly debt that are hold till their maturity period. Suppose there is a government bond that is of 25 years duration. A bank, if it is investing into that particular bond, the bank will keep that bond for 25 years. It will not sell it. Okay, it will keep that government security till 25 years. So these are hold to maturity securities. Okay, so this is one type of investment that bank does of public money. What is another type? This is available for sale securities. Available for sale securities are either equity or debt securities that any bank buys with a motive of selling it before maturity. Again, I'm repeating, this is such type of securities that a bank buy in the hope of selling it before maturity. That means, let's take an example of this government securities only. Okay, as you all know, government securities are tradable in nature. So in case of debt, this bank bought a, let's say suppose 25-year government bond. Okay, but it is marked in available for sale. That means this bank is already trying to think that whenever I'll get a good price with respect to this 25-year bond, I will sell it before maturity. That means I will not be holding it up till 25 years of age. Okay, and what's the third one? It is hold for trading. So this is also hold for trading are those type of securities that bank buys in order to sell them in short duration. That means usually a year. And this is also equity as well as debt. In equity, obviously, stocks trading, they buy Reliance stock today and within 1 year, whenever they get a good profit, they sell it. That type of securities is known as hold for trading. And what type of debt securities are there that can be sold within a year? Can anybody tell? At least tell me in terms of government securities. What do we call government securities? Yes, treasury bills. Okay. Now that you know treasury bills, what type of treasury bills are there? Tell me in terms of number of days, expiry days. What type of, how many type of treasury bills are there? Does anyone know? There are 3 types. 91 days T-bill. That means a T-bill with 91 days maturity. 182, 364. Okay. So at least now you understood that how does a bank invest public funds? Tell me, up till here, any confusion? All of you? Okay. Now we will talk about the norms. Okay. What RBI is actually talking about in terms of norms. So first thing RBI is actually talking about is at a bank must categorize any investment into these 3 categories. That means document it, whether whatever you are purchasing is either AFS or HFT or HTM. Tell or document it before purchasing that security. This is the first provision with respect to what investment norms that RBI is right now saying. Okay. What's the second one? After this categorization, that means suppose let's say you have done 5 investments. Okay. 2 HFT, 1 AFS and 2 HTM. Then the second provision with respect to RBI circular says that you cannot reclassify the assets once you have categorized it. That means you cannot convert HTM into AFS or you cannot convert AFS into HTM and then reshuffle your portfolio. This is the second thing that this circular is saying. This reclassification is only possible if you have taken approval from the board of directors of the bank itself or the regulator, Reserve Bank of India. Okay. Any confusion in categorization norms or reclassification norms? Any confusion in this? Please ask if there is any confusion. We will take it step by step. And even if you want me to, explain this in Hindi, you can also tell me. I will do that. I hope there is no issue. Okay. So we've understood this classification or categorization norm. Okay, now let's try to understand another norm. So another norm is with respect to, selling of these type of securities. These are very, secure securities. That means these are very stable securities. These are hold till maturity, and even the government as well as the creditor as well as the debtor, both are very much assured with respect to, stability of such type of securities. That's why Reserve Bank of India says that you cannot sell these securities beyond 5% of the whole HTM portfolio. So let's say, suppose your portfolio is what, 1000 crores. Okay, so you cannot sell HTM securities worth more than 50 crore rupees. Okay, this is the provision that has been given as the next in the circular. And even if you want to do this, then obviously you need approval from Reserve Bank of India. This is the second provision. Till now, here any confusion? Okay. Now, the next one, which is regarding investment fluctuation reserve. Yes, that's why this provision is this. Yes, Lakshmi. Or anyways, these are classification, na? That means bank on document is saying that we are classifying it as held for maturity. Who knows that after 25 years it will keep that or not? But at least on paper they are saying that, and commitment is that. But RBI says we will put some these conditions so that even if some rogue element comes, such type of selling will not happen. Okay, so from the regulator point of view, this is making sure that those HTM securities continue to remain HTM securities. Okay. Next is investment fluctuation reserve. This was specifically established to mitigate the impact of held for trading securities. These are very short-term securities. Although you might gain some profit sometimes, but you might also get loss sometimes. And because of which, to mitigate impact of this fluctuation reserve is developed. Okay, it provides a cushion to you. In the event of mishap, at least you have some liquidity in order to make your bank function as a going concern, which is very much important. And ironically, this and what's the, how the fund into investment fluctuation reserve, what is the provision with respect to how much fund should be in there. So the norm says that this investment fluctuation reserve shall be at least 2% of what? AFS plus fair value through profit and loss securities portfolio. That means combined value of this. combined value of this into 2%. That should be the value of investment fluctuation reserve. Okay. Any confusion here till now? I know this is a very technical circular, but if you understand it right now, remembering it becomes much more easier. Okay. So this is what is in this circular with respect to. Now let's move on to the next circular. What does it say? That banks have to pay rupees 5,000 per day if loan documents not returned. This is said by RBI. Okay, so what is the context in which RBI is actually telling us or giving this circular is all about? A lot of complaints, from customers with respect to their banks have been arriving related to, even after the closure of loan, even after, full payment of loan, full repayment of the loan, banks are not reissuing their original documents to the customers, because as you all know, there is a process. If you take a loan from the bank keep RC of a car, okay, while providing you the car loan, okay, and only when you repay this whole car loan, bank returns that RC to you after that. Okay, so those documents, getting those documents is very much essential for ownership of any property for which you have taken loan. But those, various complaints have been coming that banks are not returning back those documents. So RBI actually mandate every bank that return all documents within 30 days. And if you are within 30 days of loan repayment, that means if on 1st May you have repaid your loan and till 31st May you haven't been receiving this your original document, then from 1st June onwards 5,000 per day will be charged to the bank. Okay, so this is the circular all about. Nothing more to discuss in this, just the details with respect to what is the amount and what is the reasoning behind. Okay, if these things extend beyond 30 days, 5,000 per day will be charged on the bank, and that charge will be returned to the customer because of the delay. Okay, and it will apply from December 1st, 2023. Now let's move on to the next thing, which is RBI name 15 NBFCs in upper layer for financial year 24. What is this upper layer? How many of you know NBFC's new regulatory structure? First of all, tell me how many layers are there in NBFC's new regulatory structure? Does anyone remember? Sai, that is old news. Right now there are 4 layers. What are these 4 layers? Primary is the base layer. Then middle layer. Okay. Then there is upper layer. And lastly, top layer. This is the new regulatory structure of NBFCs, classified into 4 layers of, NBFCs will be classified into 4 layers. So let's first understand these layers and then we'll see the circular. Okay, so we'll understand these layers in brief. Don't worry, because anyway, if we want to understand this thing, it will take a whole lecture only. So just remember, in base layer, primarily non-deposit taking NBFCs will come. Okay. and those NBFCs which have asset size of less than 1,000 crores. Now reverse it, you will get the details with respect to middle one. That means deposit taking NBFCs plus asset size of more than 1,000 crores. Okay. In upper layer, this is a new layer created in this regulatory structure. Top NBFCs will be arriving. India's topmost NBFCs will be there in upper layers. What do we mean by topmost NBFCs? These are systematically important NBFCs. You know, just how you understand the concept of systematically important banks. Similarly, there are systematically important NBFCs. Why? Because they have a lot of exposure with respect to various sectors. What do we mean by exposure? That they have either lent to various sectors or either they are actually refinancing to various sectors. This is what we mean by exposure. Okay. And top layer, RBI says it will ideally remain empty. Because what can you get on the top of the top? Various stringent conditions is there with respect to top layer, and no bank right now is on the topmost layer. So this is the brief introduction of these 4 layers of NBFCs. Now see what's the circular or what's the news is all about. RBI names 15 NBFCs in upper layer for financial year 24. So 15 NBFCs have been decided as the topmost important NBFCs, beyond which no NBFCs is there. That's why they have being kept in upper layer. I will zoom it so that you at least understand or remember the names of these NBFCs that have been. Are these things clear? Is this visible to you? Okay. So LIC Housing, Bajaj Finance, Shriram Finance, okay, Tata Sons, L&T Finance, Piramal Group, Cholamandalam, India Bulls, Mahindra, Tata Capital, PNB, HDB, Aditya, Muthoot, and Bajaj Housing Finance. Okay, so these are such NBFCs that are under top layer. Okay, so just go through that list once again. Now what's the next? I'm saying just at least go through this list 3 times. Okay, if you go through this list 3 times, then if any question, although the probability is very less, if any question comes with respect to this, if you have seen the list at least 3 times, you will be able to mark the option much better than other people. Okay. So the important portion, see, there are various reasons with respect to why RBI tried to create 4-layer structure. Okay, there is obviously a particular reason with respect to financial stability, as you all know, that because of ILFS crisis and because of various other NBFC crisis as well as twin balance sheet crisis, Indian financial sector realized the importance of regulating NBFCs much systematically. So the primary reason was that, and because of which, and since all of you know that NBFC sector is such sector that is, very differentiated. When I talk about differentiated, that NBFCs are involved in various different sectors, various different asset classes, and various different sections that they are catering. So 2-layer structure was not actually fulfilling the need. Another reason because of which this layered structure was made, because of the emergence of fintech. Fintech actually was, enabling development of various type of NBFCs. What do we mean by various type of NBFC? Account aggregator is one such type of NBFC. Okay. Account aggregator, what does account aggregator does? It aggregates all the data with respect to all the customers, all the banks at one place, so that the facilities with respect to, all the data can be provided to other people or banking sector in order to make innovation. So to incorporate such type of new entities that are coming into the fintech space, this new structure was to be made in such a way so that they can also be incorporated in that. Okay, so these were two primary reasons. And the concept of top layer, that is a standard, that a ideal place, that's why they said ideally it won't be there, but realistically who knows, NBFC become so big that it might go into that layer. Next is about RBI's Financial Inclusion Index. Okay, so it points at 60.1% in the March. Okay, so this is the data that tells us about that how financial inclusion is actually increasing in the country. Previously in March 22, as you can see, 56.4% of India's financial space in terms of financial inclusion was this. Okay, but right now 60% of India's population, as you can say, has been put under the ambit of financial inclusion. So remember, you will remember this data very much critically. You will remember the previous data also very much critically, and obviously the static portion that you all need to remember. What's the static portion? That this is the three criteria based upon which this index actually calculates the percentage. Also, it was launched in 21. Okay, so access 35%, usage 45%, and quality 20% weightage. So these are the things. Please remember this static portion, these things already marked in bold, and this data of last year as well as last to last year, 56.4%. Next is mutual funds, alternative investment funds needs to get authorization for each scheme. It is said by IFSCA. IFSCA. Okay, so first of all, can anybody tell me what was the need to establish IFSCA when you already have SEBI to regulate such things? Good afternoon, Karthik. Why do you think IFSCA was established? Anyone? When we have already a very good institution in SEBI, why do you think there was a need to establish IFSCA? Because in this circular, nothing is this. As this is a very just peculiar statement by the IFSCA is that to all the companies present in GIFT City, if you are launching any particular scheme, you need to take authorization from IFSCA, and this is specifically for mutual funds agencies, HDFC Mutual Fund Group as well as other groups. If they are launching any scheme, they will first take approval from IFSCA. Another thing, alternative investment funds. What do we mean by AIFs? Alternative investment funds include funds that are not listed on the stock exchange, such as venture funds and other funds. If they are coming up with new schemes, they'll take approval from IFSCA. So this is the circular which you will study. Even here you will get the same information, but I am asking, what was the need for IFSCA? Science says for international transactions at ease. So even SEBI allows you international transactions at ease. If you want to invest in US stock exchange, SEBI says just register with me and do such transactions. Don't worry. Karthik says transparency. Even SEBI put various disclosure norms with respect to transparency. Why do you think IFSCA was essential? Now think broadly. Don't get restricted in terms of So primarily understand that this was established for India's first international financial service center. Okay, so international financial service center is a particular area within India's territory, but this acts as a foreign economic territory where various tax exemptions are there and various incentives have been provided by the government in order to make this a financial hub. Okay, and since this will become a financial hub, it will incorporate various activities related to the finance, and finance not only includes stock market, capital markets, money market, it includes banking, it includes insurance, it includes pension, it includes various type of financial activities. So when there are various type of financial activities going on in a particular place, and that too being involved in a global sphere, okay, so it needs a swift inter-agency or inter-regulatory coordination amongst all the regulators that we have. And all of us know how this is, how much difficult is this. That's why government came up with IFSCA, that will act as an umbrella regulator that will oversee all of the regulators, all of the task that is going on, and will regulate it on the basis of their sector. That means banking regulation will be there, insurance will be there, every regulation will be there, and that will be done by IFSCA. Okay, so this was the motive behind establishment of IFSCA. Now, who will tell me there was one, commission that actually talked about creating a unified regulator. That means a single regulator that will incorporate IRDA, PFRDA, SEBI into within that organization. That means IRDA will be a particular department within that regulation. Sorry. Try to search it and tell me in the next session. Okay. Next is RBI's monthly bulletin. Okay. And within this monthly bulletin, various news are there. First news, as you can see, equity FDI inflows nearly half on global overhang. Okay, so as the circular's title is saying, it is very much self-explanatory that because of various global economic downturn, the FDI inflows into India has been reducing. Why do you think this global downturn is there? And this is important from your descriptive perspective. Don't think it in terms of objective, because there is nothing detailed, that is very much static, that will come into your objective. No sign, not Nasiman. It is in, if you look into it, 2007, 2008, think in terms of that. There was that committee. Now, first of all, think this circular news, for your descriptive paper. Why do you think global overhang is there? Any reasons? What can you tell? What are the major reasons because of global economic slowdown is happening? Let's try to give answers. I will give Russia-Ukraine conflict. What else? I stole your answer, Sai. Give me some another answer. Recession? What recession? Recession, be specific. Don't give just one word answer. And also, others also try. Why do you think global slowdown is happening? Let's try to do this in a flowchart format. What happened because of Russia-Ukraine war? Anyone? It led to supply chain disruptions. Okay. And when there is less supply in the market, what will happen? Whenever there is less supply in the market and the demand is constant, what will happen? Tell me. Yes. And after inflation, what is the usual move of every government? Monetary tightening. Okay, that means increase in interest rates, increased interest rates, and whenever there is an increased interest rates, what will happen? Slowdown in growth and other things also. Currency depreciation, increased debt, and you can go on. Okay, so think in terms of flowchart, you will be able to come up with various points. Okay, so because of global overhang, as you can see, the data tells you that from the previous year, when FDI inflow was $22.04 billion, it has come to $13.9 billion, which is very much low. Now, whatever we were discussing about in context of monetary policy tightening, that means increased interest rates, see the impact of that policy. Read this: 34% loans charged 10% or more interest. Current FDI in insurance is 74%. So, did you see 34% loans charged 10% or more interest? That means if you go and ask bank for a loan, bank is saying that we will give you loan, but the interest rate is more than 10%. Are you willing to buy, or are you willing to get that loan? And why do you think this interest rate is higher? Because most of the banks, okay, right now, the RBI has already mandated that most of their banks interest rate will be linked to external benchmark rate. Okay, and most of the external benchmark rate is the repo rate. And who will tell me what is the current repo rate right now in the country? What's the current repo rate? How much percentage is there? Anyone? Yes, 6.5%. Okay. And when the Reserve Bank of India actually started to increase those interest rates, what was the repo rate at that particular point of time? It was 4%. So if you see, 250 basis points has been increased. Okay, so if any interest rate of a particular bank is connected with this repo rate, then that interest rate will also have increased at least 2.5%. If we are excluding any other things that banks are including within their interest rates, if on at least only on the basis of repo rate increase, we can easily say interest rates that are linked to external benchmark rates also would have increased at least 2.5%. That's why we are seeing 34% of the loans being 10% or more, with 10% or more interest. This is what you will find in this lecture. See, because of RBI's Monetary Policy Committee's increase of 250 basis points, all these interest rates have been increased because they are repo linked external benchmark based lending rates. Any confusion till now? This is another basic news which talks about ECB registration declines for the first time in financial year 24. What do we mean by ECB? External commercial borrowings. Okay. External commercial borrowings that corporates usually take money from outside by issuing either corporate bonds okay, or direct loans. So this news is actually saying that right now this is the lowest of external commercial borrowings that we are seeing right now. This was the situation in June 2023, and what you see right now is 2.56 billion. And since all of these things are under RBI bulletin, these are very important for you to remember. Okay, so let's finish this now. Rest of things we will discuss tomorrow. Okay, any confusion till now? And I'll request all of you guys to again go through that the first circular, okay? Because if you go, already we've discussed it 2 times. Once again, if you go to that now, that thing will become much clear to you. And if you have any doubts, feel free to ask in the comments, or in the tomorrow's session that I'll do, ask me over there. Current WPI inflation right now is in the negative territory. Okay, so we'll see when we will do this lecture tomorrow, the remaining portion. Okay, ironically it is in negative. Okay, and whereas CPI has also declined, but it is still above Reserve Bank of India's target of 6%. ESI static, important topic. I will do one session, okay, with respect to that. Or I will take this for tomorrow. Okay. So thank you all of you for joining. We'll meet in tomorrow's session. Thank you.